Internal Revenue Service IRS Tax News. Tax Time Guide. Get credit for IRA contributions made by April 15th on 2020 tax returns. IR 2021-53, March 11th, 2021, Washington. The Internal Revenue Service notes that taxpayers of all ages may be able to claim a deduction on their 2020 tax return for contributions to their individual retirement arrangement, an IRA. You might know it as an individual retirement account or individual retirement arrangement, an IRA, made through April 15th, 2021. So I'll give you my quick recap on the individual retirement arrangements, the IRAs. They're going to be an incentive for us to put money into a retirement type of account. They're going to be similar to other type of retirement accounts you might have through your work, such as a 401k plan for companies or a 403b plan, often for like government type of workers. And when you put the money into the IRA or into some type of retirement plan, you'll typically get the benefit at the point in time you put the money in. That benefit generally being that the income will not be included in income, or you can think about it as a deduction. In other words, if you look at the 401k type of plan or a 403b, something through the work, then they take it out of the box 1 on your W-2. So that means for federal income tax purposes, it's not included in the wages, and therefore you're not being taxed on that particular portion. That's one reason that when you look on your W-2 and you want to think about what you actually earned, you might want to look at like the Medicare wages or something like that could be closer, because if you do have a retirement account like a 401k plan, box 1 will typically be reduced, because that's the easiest way that for us as the taxpayers to fill out the tax return. If you don't have the retirement plan through work, or if you also want to add on another contribution, if you have the ability to do so, then you can put money into an IRA. When you think about an IRA, they can't take the money directly out of your W-2 wages because it's not through the employer in that case. So that means we have to have a deduction instead, but it's an above-the-line deduction and therefore not part of the itemized deductions. So you should be able to get access to it even if you do not itemize. And it's kind of a similar kind of thing because it reduces the adjusted gross income, so you can kind of think about the above-the-line deductions as basically adjustments to income, because the phase-out limitations for the IRS are basically based on the adjusted gross income, which are after those above-the-line type of deductions for adjusted gross income. Now, the great thing about the IRA is that they even though you're going to get the deduction in 2020, unlike other types of things, because the tax return is typically on a cash basis, they actually give you some leeway after the year has ended, meaning you don't have to contribute in 2020 necessarily in order to take the deduction. You could contribute up to April 15th of 2021. So if you file on time, not including extensions, then you could basically still do some reporting or put money into the IRA, which allows us then to do some last minute type of tax planning. This is like the last thing you kind of typically often think about, or something that your tax professional will then ask you about when you do the tax return. So if you're getting your tax return done, if you're doing it yourself, or if you're going to a tax professional, be ready to ask that question. Either the software you are using or the tax professional will possibly ask you about it. Now, your amount you can put into an IRA will vary based on whether your income limitations, and it will also vary as to whether you have access to another type of retirement plan, such as a 401k plan or 403b plan through the work, which is another great reason that it's really nice that the IRS allows us to not be required to put money into the IRA in the year in which we're going to take it, but do that last minute tax planning so we can put our information into the tax software. And the tax software then can help us to determine whether we can put money into an IRA still, how much we can put into the IRA at that point. Most tax software often also giving us information about what the tax savings will be, meaning if I put this much into the IRA, how much reduction in the taxes will that result in? So that was a kind of a long recap, but there's the recap. Back to the text. There's no longer a maximum age for making an IRA contribution. So there's no maximum age, which is nice. An IRA is designed to enable employees and self-employed to save for retirement. That's going to be the incentive. How does the government incentivize us to save for the retirement? They're going to say, hey, put money into this IRA, as opposed to some other account, and we're going to restrict you from being able to take it out of that IRA, which means if we didn't have any tax benefit for it, we wouldn't do it, right? Because we would put our money into some other account, even though we'd still save for retirement, but we would put it into some other account that I could access if I need to without being penalized. But the IRS is saying if you put it into this account, which will limit your access to it, you'll get the benefit of, the tax deduction, which is why we put it into that account. So most taxpayers who work are eligible to start a traditional or Roth IRA or add money to an existing account. Now note that a Roth IRA is kind of like the opposite type of situation. Instead of getting the tax benefit at the point in time you put the money in, you're going to basically not pay the taxes when you pull the money out. So when you put the money into a traditional IRA, you get the deduction now. When you put money into a Roth IRA, you don't get the deduction now, but when you take the money out at the end, you don't have taxes at that point. Why would you want to put money into one or the other? It really depends on what you think the tax rates and what your standard of living and whatnot will be at retirement or compared to this point in time. If you're at your peak earning situation at this point in time, then you're typically saying, hey, I'd like to deduct as much as possible right now because I'm probably in the highest tax brackets I would be at if there were no tax increases and whatnot. And when I retire, then maybe I'm going to be living on something less than that, and so therefore I would put my money into possibly a traditional IRA. However, if you think that taxes are going to blow up for some reason or something like that, or if this year, for example, was not a good year for wages, which it wouldn't be for many people, but you still have some money that you would like to put into an IRA, you might say, hey, it's not worth it for me to put it into an IRA right now because I'm not getting a big tax benefit from it. And if I'm not getting a big tax benefit from a traditional IRA, why would I put it in there and restrict myself from getting access to my own money if I'm not getting a big tax benefit? But you might say I might put it into a Roth IRA in that case, so that when you take the money out, you'll get the benefit at that point in time. So that's a general overview. Contributions to a traditional IRA are usually tax deductible, and distributions are generally taxable. That means you're basically deferring the tax. You're getting the tax deduction now, or in other words, it's being pulled out of kind of like your income. It's an above-the-line deduction, a deduction for adjusted gross income. But then when you take the money out in the future, the IRS is going to call it income at that point in time. So it's still income, but it's kind of like deferred income when you're thinking about a traditional IRA. There is still time to make contributions to that count for a 2020 tax return if they are made by April 15, 2021. So we do have that extended deadline. That's unlike most other things for taxes, which are generally on a cash basis. We have until April 15th to put money into the IRA. Taxpayers can file their return claiming a traditional IRA contributions before the contribution is actually made. The contribution must then be made by April due date of the return. While contributions to a Roth IRA are not tax deductible, qualified distributions are tax-free. So the Roth IRA, as we discussed, is kind of like the opposite situation. In addition, low and moderate income taxpayers making these contributions may also qualify for a saver's credit. There's a link to the saver's credit if you want to look that up as well. Generally, eligible taxpayers can contribute up to $6,000 to an IRA for 2020. So that's generally going to be the cap. So if you're a single individual, $6,000. If you're married, possibly $6,000 for the two spouses involved. But be careful, because if you have access to a 401k plan or some other retirement plan through work, there could be other restrictions to it. Also note that if you do have access to like a 401k plan or a 403b plan, some type of retirement plan through work, the amount that you can put into that plan is typically higher, and it's a huge benefit. So what you want to do, and this is the kind of problem with these plans, of course, is they only benefit you if you have cash flow that you can actually put in and lock into a retirement type of account. But if you do have that, it could be it's a big tax deduction and often generally worth doing. So if you have access to a retirement plan through work, then the typical strategy is to maximize it as much as you can at that point in time. And you have to basically do that usually before year end, because you can't generally put money into the 401k plan after year end would be the general rule. If you have your own like SEP IRA or something like that, or a simple, then you can look up the rules for that if you have like a sole proprietorship and a Schedule C type of business. But then the general rules, you'd want to max those items out so that it would be taken out of your W-2 and not reported in box 1 of the W-2. And then when you file your tax return, see if you still qualify for any other IRA contributions at that point in time. Tax software helping with that process. If you do and you still have the cash that you could put in, then take that added IRA contribution. But if you have access to the 401k plan, that's usually the first place you want to look, because again, the amount that you can put into it will typically be higher. So for someone who was age 50 years of age or older at the end of 2020, the limit is increased to $7,000. So there's increase if over 50 of age or older at the end of 2020. The restrictions on taxpayers age 70 and a half or older to make contributions to their IRA were removed. Now this is interesting. So once again, let's read that over. This is kind of new here. The restrictions on taxpayers age 70 and a half or older to contributions to their IRA were removed in 2020. So qualified contributions to one or more traditional IRAs are deductible up to the contribution limit of 100% of the taxpayer's compensation, whichever is less. For 2020, if a taxpayer is covered by a workplace retirement plan, the deduction for contributions to a traditional IRA is generally reduced depending on the taxpayer's modified adjusted gross income. So once again, if you have access to a retirement plan, then that could limit, even if you don't put the money into the retirement plan, it could still cause some limitations to the amount that you want to put into the IRA. So traditionally or generally, you want to take advantage of the 401k plan and put as much as you can in, even though you don't have really the hindsight of being able to do this after the year has ended, and then see if you could still put money into the IRA, even though you have access to a 401k plan at the end of the year. So single or head of household filers with income of $65,000 or less can take a full deduction up to the amount of their contribution limit. For incomes more than $65,000 but less than $75,000, there is a partial deduction, and if $75,000 or more, there is no deduction. Filers that are married filing jointly or a qualified widower with $104,000 or less of income, a full deduction up to the amount of the contribution limit is permitted. Filers with more than $104,000 but less than $124,000 can claim a partial deduction, and if their income is at least $124,000, no deduction is available. For joint filers where the spouse making the IRA contribution is not covered by a workplace plan, but their spouse is covered. So once again, note, funny situation here. We're talking about now married individual. They have access to a retirement plan, but one spouse does and the other spouse does not through work. Retirement plan through work like a 401k plan. So once again, for joint filers where the spouse making the IRA contribution is not covered by a workplace plan, but their spouse is covered, a full deduction is available if their modified AGI is $196,000 or less. There's a partial deduction if their income is between $196,000 and $206,000, and no deduction if their income is $206,000 or more. So you can see how this gets a little bit complicated. You can see how if you're using tax software, it can really help to figure this out, which is really nice that the IRS allows us to figure this out basically after the year end and make the contribution in 2021, even though we're going to be filing it in 2020. Also note that if you're dealing with married couples and you're doing the tax return to try to figure out how much might be able to be put into an IRA, this is one of those situations you got to make sure that you're applying the W-2 information to the proper spouse. So even though it's all income, your one taxable unit and whatnot, in order to get this kind of calculation right, you got to say, hey, this W-2 income is for this particular spouse, that W-2 income is for this particular spouse, and then make sure you're marking off whether or not there is an available retirement type of plan like a 401k plan that is on the W-2. It should be indicated on the W-2. So if you get that in the tax software properly, the tax software hopefully can then get this IRA contribution calculation calculated, and then you can determine as to whether you want to take it or not. So filers who married filing separate and have an income of less than $10,000 can claim a partial deduction if their income is at least $10,000. There is no deduction. So if you're married filing separate, The IRS is very skeptical of people that are married filing separate when it comes to these kind of special type of deductions, because they do not want to incentivize people to file married filing separate simply to take advantage of some of these AGI type of limitations. Therefore, you can see they severely put a limitation on married filing separate for this particular thing. So worksheets are available in the Form 1040 instructions. There's a link to that here, or Publication 590A, Contributions to Individual Retirement Arrangements. There's a link to that here. The deduction is claimed on Form 1040 Schedule 1. So that's kind of like the above-the-line form at this point in time. They may totally switch it by the end of next year, but I kind of like, I'm getting used to it. But in any case, Schedule 1, it's on Schedule 1. Deductible contributions to a traditional IRA are reported on Form 8606 non-deductible IRAs. There's a link to that here. Even though contributions to a Roth IRAs, there's a link to that here, are not tax deductible, the maximum permitted amount of these contributions begins to phase out for taxpayers whose modified adjusted gross income is above a certain level. So we got similar type of situations with the Roth IRA. So if you're putting money into Roth IRAs, you got some similar kind of AGI situations that you got to be taking into consideration. For filers who are married filing jointly and qualified widower, that level is $196,000. For those who file as single head of household or married filing separately and did not live with their spouse at any time during the year, that level is $124,000. For filers who are married filing separately and lived with their spouse at any time during the year, any amount of the modified AGI reduces their contribution limit. The Savers Credit. There's a link to the Savers Credit here, also known as the Retirement Savings Contribution Credit, is often available to IRA contributors whose adjusted gross income falls below certain levels. So if your adjusted gross income is below certain levels, the IRS, the government is trying to super incentivize people to save for retirement, given the fact that it's more difficult due to the fact that the cash flow is low. And so they're going to have the Savers Credit kind of tacked on as well to incentivize people to put the money into the IRA, locking it down until you retire. So, or until, you have some reason that is legit to take it out, otherwise you get penalized. So in addition, beginning in 2018, designated beneficiaries may be eligible for a credit for contributions to their Achieving a Better Life Experience, the ABLE account, ABLE. For 2018, the income limits are $32,500, single and married filing separate, $48,750, head of household, $65,000, married filing jointly. Taxpayers should use Form 8880, Credit for Qualified Retirement Savings Contribution, to claim the Savers Credit and its instructions for details on figuring the credit correctly. Taxpayers can find answers to questions, forms, and instructions and easy-to-use tools online at irs.gov. They can use these resources to get help when it's needed at home, at work, or on the go. These new release is part of a series called the Tax Time Guide. There's a link to the Tax Time Guide here, a resource to help taxpayers file an accurate tax return. Additional help is available in Publication 17, Your Federal Income Tax for Individuals. There's a link to that publication here. More resources can be found at the link below, which is Do I Qualify for Retirement Saving Contribution Credit? There's a link to that here. There'll be a link to this in the description.